Welcome MMTs, Saturday morning, and basically what we're looking at is the weekly chart. Right up here where my pointer is, it's the VIX. It's a 1 weekly chart. So each one of the barrels here or candlesticks are based on 5 days of trading. And basically we cannot break this bottom. And the reason why I have this up here is that once again, when we got this level here, was in the beginning of the year. When we broke out, the indexes sold off real hard. These indexes right here. So that VIX right here is at very low levels, but we're building a 1, 2, 3, 4, 5, 6 with a breakout weekly bar coming off a 7-week price action base. And what that means is that the amount of selling that we get here, we start to get that fear built up. Another thing, MMTs, if this bar right here, which is 20.41, half of the bar is 20.41. If I stay above that weekly 20.41, that means that I'm building momentum. When this breaks higher, stocks go down. When this goes way down, you have bull runs. And when this goes straight up like it did, the bears are in control. So the bear has really been holding this build up right here. Okay? And the key bar is if this thing holds support at 19.53, this is last week, that was the prior week, that's half of that bar. That's where that fear indicator, and that's bullish for the VIX. If that breaks higher, equities are going to go lower in price. I'm going to make it that simple. So when we start off tomorrow morning's trading, the key number will be this bar right here. This is 20.41. That's half of the last week bar. If I don't break below that, and I'm accumulating that, that means there's a breakout to come. That means that the indexes could get torched. So we're going to be very, very intently watching this move. The other thing that we're going to be watching is if I close above this last bar right here. Whoops. If I close above half of this bar right there. This is the one. If I close above half of this bar right here, this is where we had the last breakdown of this consolidation. That means that this trend is going higher. That means that equities are going to go lower and indexes are going to go lower. And what it means is if this breaks higher, that means that the bear ETFs are to be bought, because if this is going to show the complete complacency between buyers and sellers of what goes in the Wall Street transaction tape. That's everyone combined outside of floor traders and market makers and things like that. And basically, we're setting up for a breakout. We will have to reverse that. And we're going in toward the end of the month. And basically, if the bulls don't come in and start buying, then this will go higher. But the most important thing is, how do you gauge the public transaction and what they're doing? And basically, there's no fear here. Just like the fear level was very low here, they created some fear, all right. They broke this thing last time right down here off of that teeny low right there, and they broke that thing all the way up to 47. And that was back during, and part of this was during the flash crash and the April reversal. We have all the live videos on Stock Market Funding. Go find them. Here's another thing, though. It's all about this part right here. It's all about this current part of the trend. So basically, half bar, there's your breakout, there's your resistance. If you close above half of that bar right there, which is 23.25, that's 23.25. If I go up through resistance and I hold above that mathematical equation and it's 100% accurate, it will tell us that the fear is building higher and equities are to be sold short intraday. Because what's going to happen is, yeah, equities will make a move off the bottom, but they're not going to go that far. They may go $1.50 or $2 off the bottom, but then they roll back over and make lower lows. And so understanding what this is all about. And here's another bar right here. This is a very important bar as well. And it's way over here during this time frame. Here, let's see if I can get it to populate for the MMTs. For some reason, it's not bringing it up to the front. But half of this bar here was when this was going down, the markets were breaking higher. And we put this bottom in right here. This is a mathematical line that's created in the platform. It's not wrong. And it also will tell you that past performance between the buyers and sellers repeat themselves. But the fear indicator is this is an alarming thing in the short term because it's setting up for the breakout. This is a confirmation week. It's above half of the bar, 19.53. As a matter of fact, this is what it's about. And this bar here is going to be that 20.41. Okay? And I don't know why this one's not. Oh, yeah, here it is, 26.67. That's on 8/30 of 2010. Half bar, resistance up for the VIX will remain at that level, 26.67. If you can clear this one right here, that's one of the bars that we had talked about over here. This is 23.25. So these are the resistance one at 23.25, a close above 23.25, and a consolidation means that these indexes remain in trouble and that they go down in value. They don't go up in value. That means that all of the Dow, the NASDAQ 100, the NASDAQ comp, the S&P, all of them will have resistances that roll over because this goes higher. So basically, we've got everything right here. 23.25 is the next level. And the VIX closed at 22.22, 2.8% on the 2.80, 14.42% move. So look, this is what's going on in North Korea, Ireland, Spain, Portugal. The war games going on right now is playing a major factor in here. And the blue line here is the 20-week moving average, and we're above the 20-week. The red line is a 20-week simple moving average, but we are looking at our price bar actions. These are lagging. This is up to date with the price. So basically, that's the gift of understanding that VIX. And there's another indicator that's related to the NASDAQ 100. You take the VXN right here, and the NASDAQ 100 and the NASDAQ comp, that's the fear indicator for those. Complacency. The more complacent the public gets, the bigger the pullback or the correction happens.